Hi there. Welcome to Commodities. I'm Lindsay Biscaya. Let's get to some of the stories we're tracking for you in the BNN Bloomberg newsroom this afternoon. Cuba has completely run out of fuel amid a U.S. energy blockade. The island's energy minister says it has run out of the diesel and fuel oil that it needs to keep its power plants running, adding that civil unrest is starting to break out. The country's electrical union says it could only cover about a third of national power demand. Cuba has been using domestic fuel and solar energy to generate some electricity. However, large areas of the country are now going dark. China has renewed import permits for hundreds of U.S. beef plants. According to a report from Bloomberg, the permits were renewed today and are valid for 5 years. The move revives trade of the meat after Beijing allowed import authorizations of the meat plants to lapse last year following U.S. President Donald Trump's tariff war. The renewals come as the U.S. and China agree on reviving trade in other agricultural products, such as China's purchases of American corn and soybeans. And India has banned sugar exports for more than 4 months. The government says the move is to protect local supplies and follows a cut in output estimates from one of India's major millers group. India also warns its next harvest in October could be affected by a lower than average monsoon. The announcement comes after the government said last month it would not curb overseas sales. And we're going to take a look now at how some of the key commodities are trading today, starting with oil. We've obviously been watching this closely over the last couple of months, really ever since this conflict began in the Middle East. It's holding relatively steady today as the Iran war remains in limbo. Oil up by 0.3% at the moment. And we know that obviously Donald Trump in China speaking with Xi Jinping. So obviously this war on hold at the moment. Gasoline not tracking oil for once. It's down by 0.2%. And we're also watching natural gas. You can see it's up almost 2% today, but 1.7% at the moment. It is rising on smaller than expected storage increases. And also, many gas-focused producers are reining in output during a period of seasonably mild weather. So we are seeing natural gas climbing today, 1.7%. If we take a look at where some of the metals are trading as well, gold has been fluctuating quite a bit recently, fluctuating today once again. It's down 0.6% at the moment. This comes as markets are weighing the potential for some rate hikes moving forward, specifically in the U.S., with Kevin Warsh taking the reins. Many analysts saying it's very likely that the U.S. in particular could see some rate hikes rather than rate cuts later this year, and you're seeing that reflected in the price of gold. Silver also down 5% right now, and copper is retreating from a record close as purchases in China are slowing as investors monitor that meeting between Trump and Xi Jinping. Copper was rising the last couple of days, now is down more than a full percentage point. U.S. President Donald Trump has told Fox News that Chinese President Xi Jinping has committed to assisting the United States with Iran and has agreed to purchase U.S. soybeans, oil, liquefied natural gas, and other energy products. So to discuss these developments and what a more stable U.S.-China bilateral framework after the summit could mean for Canada, we're joined now by Dominic Chu, senior analyst at Eurasia Group. Good afternoon. Thanks so much for joining us.
Thank you. It's my pleasure.
So let's talk soybeans. U.S. Treasury Secretary Scott Bessent has stated that China's current purchase commitments are all taken care of. Considering weak domestic demand right now and competitive prices from Brazil, do you believe imports will still remain below pre-2016 levels right now?
I think it will remain below. However, I do think that the Chinese are going to continue to purchase American soybeans because those are baseline deliverables for the Trump-Xi summit. These agreements were effectively settled at the Paris trade talks 2 months ago and at the Seoul trade talks 2 days prior to the summit. You've mentioned in the headlines about the good news around American beef as well. I just expect more formal announcements of commodity agriculture-related purchases tomorrow because that's such a key ask from the American delegation that the Chinese will make those purchases moving forward. I think that those purchase levels will remain below previous years.
Sorry, I just want to dive into what you're maybe expecting to be announced tomorrow. What exactly do you mean?
Well, I mean, purchase commitments on soybeans, on other agricultural products, as well as perhaps American energy products as well. Those details, as I said, are probably already settled at the trade talk between Treasury Secretary Scott Bessent and the Chinese Vice Premier He Lifeng a couple of days ago. They're just waiting for both leaders to meet and be announced at the conclusion of the summit. That's my expectation.
Got it. Okay. So with that in mind, do you expect the U.S. will kind of encourage increased Chinese imports of grains and meat moving forward?
I think they will continue to push for that. Like I said earlier, the agricultural constituency is very important to the Trump administration and to the Republican Party. That is one key ask that the Americans have put pressure on the Chinese consistently since the beginning of the trade war. Now that we're not expecting a trade war to reemerge anytime soon, however, that remains a key request from the White House to Beijing. And I think Beijing will be receptive to that.
What's interesting is how the conflict in the Middle East kind of ties into this, right? Because we're seeing really high fertilizer prices right now, given the Middle East conflict. With that in mind, how confident are you that U.S. farmers will have adequate supply to meet the demand of the Chinese market?
I think if there's insufficient demand to meet the Chinese market, that adjustments can be made regardless of the pressures that are facing that the consumers are facing from the Hormuz trade. Look, I think honestly, now that you've mentioned the Hormuz trade, that is probably the most notable thing to come out of the U.S. readouts of the summit so far, is the set of consensus that Xi has allegedly reached with Trump on Iran and the Hormuz trade. China has not shifted its foreign policy position on the Hormuz Straits in any way, but it has agreed to Trump's position and the U.S.'s broader position on Hormuz. So on the whole, it is positive. I don't think that China is going to assist the U.S. in putting pressure on Tehran to lift the blockade. So, but on the other hand, it's all stepping in the right direction.
Right. But you're not worried that U.S. farmers might have a struggle here when it comes to the shortage in fertilizer in meeting, Chinese market demand. Like, as you said, you feel like there's adjustments that could be made if that was to happen?
I think that adjustments could be made, yes.
What kind of adjustments do you think?
Well, I think, if we're looking at the domestic Chinese market, for example, there is this shortage of fertilizers in the spring season. And I just think that given the political situation ongoing, we expect there to be a ceasefire to continue and the deal to be made in the 2 months. So I think just in terms of the time horizon, that fertilizer producers and so forth, they could make those expectation adjustments moving forward.
Okay, got it. So going back to this meeting that's happening right now in Beijing, these meetings over the next couple of days, we haven't received an update yet regarding critical minerals. Do you expect China's previously lifted export restrictions to be extended after this meeting between the two sides?
I do expect those export control suspensions to be extended. Maybe not at this meeting because we're still 5 months away from when those export control suspensions will expire. So maybe those extensions will be announced at a later time. But I do expect those extensions to be made eventually because they're such a key part of maintaining the stability and truce between the two countries. Now, critical minerals, as you stated, are not front and center in the summit statement so far. But I expect Washington to keep coordinating with China to make sure that these minerals will continue to flow to U.S. end users.
What do you think the implications are for Canada following this summit, given that it follows a recent meeting between Canada and China a couple of months ago that at the time was not exactly well received by President Donald Trump?
So I think overall it's positive for Canada because the summit established a more stable U.S.-China bilateral framework that will give Canada some near-term breathing room. And what I mean by that is that the summit establishes clearer parameters around what kind of trade and investment with China is permissible for third countries. Whatever baseline the U.S. accepts in its own economic relationship with China effectively sets a benchmark for third countries, including Canada. So if the U.S. decides to do some types of trade and investments with China in specific sectors, it will be diplomatically harder for the U.S. to tell others, including Canada, to not do that. Now, the reverse is also true, right? So if Washington does not foster trade with China in specific sectors, that Canada does business with China in, that will carry a greater risk. But I think in terms of in the realm of commodities, that's less of a risk. The risk is mainly in the technology and military-related sectors.
Okay, we'll have to leave it there. We're out of time. Dominic Chu, Senior Analyst at Eurasia Group. I appreciate your time today. Thanks so much for joining us.
Thank you.
Up next, we've got a discussion with Catherine Cobden, President and CEO of the Canadian Steel Producers Association. More on that when we come back. Stay with us. Canadian steel has faced significant challenges due to U.S. tariffs over the past year, prompting the federal government to introduce billions of dollars worth of financial support for the industry. Our next guest welcomes this assistance, but believes more work is necessary. So let's bring in Catherine Cobden, President and CEO of the Canadian Steel Producers Association. It's great to have you join us.
Thanks for having me.
So you believe more work could be done. Where do you think more work could be done? I mean, is there something else you believe the federal government here in Canada could do?
Yeah, so, this is, we're going on to 15 months of the tariff war between Canada and the United States, unjustified tariffs on the Canadian shipments into the United States, which has seen our shipment levels drop by 60%. So very consequential impact. And for many months, the Canadian government has been helping us. There's been new measures adopted at the border on, certain trade tools, et cetera, as well as financial supports, as you mentioned. What our strategy has been from the get-go has been to align with the United States. And so there still are these areas where we need to seek, more explicit alignment. And I think they're going to be necessary for that return of market access.
I want to ask you about USMCA, or CUSMA as it's known here. In your notes, you mentioned many U.S., Canadian, and Mexican groups view this as the most effective way to compete and surpass China in the steel sector. Has this cooperation yielded any results yet, do you think?
Yeah, so, I think there's a uniqueness to the steel sector that doesn't reside in many other sectors, and that's that we are combating on a daily basis overcapacity in steel globally. And so that comes into the shores of North America and really distorts our market, impacts our prices, and has an effect. So up until 2025, when the tariffs came on us from the United States, we were really working in lockstep with the United States to basically bring, kind of a united front against that global overcapacity. Under the trade war concept, that's been harder and harder to do because, of course, we're not in alignment anymore as we have been, targeted by the United States tariffs. So our hope is that we're going to get back to, under a renewed agreement, a renewed approach. We're going to get back to working together on common problems rather than fighting in amongst between ourselves while this common problem only gets bigger.
Speaking of those tariffs, last month, Trump expanded the steel tariffs to include previously exempt derivatives, such as like steel coils. So with these even new additional measures in place, how much more challenging is it to move Canadian steel across the border now?
Yeah, so what those so-called derivative tariffs are doing is they're targeting our Canadian customers. So we sell to, for example, a tractor producer, and then the tractor goes into the United States, where before that might not have been tariffed. Now the derivative tariffs are capturing our Canadian customer base. What this has done essentially is created more urgency to get this 232 regime down. Not only do we have the direct 50% tariff on our own products going into the United States directly, but our Canadian customer base is being devastated by these tariffs as well. So, that's one of the specific areas that we hope to engage with the federal government to do more work to expand the existing work that they have done for us, which we are grateful for, but to expand those border measures to support more of our customer base as well. They're under the exact same situation that we're facing.
Are you optimistic that the federal government will work with you on that?
even if they are, the one thing that's been the case from the get-go in this trade war is we cannot make up in our domestic market all that we have lost with our U.S. market access being closed. So, I'm optimistic. I've seen, a step-by-step approach by the federal government that has really helped us. So I'm optimistic they will be open to doing more as the urgency of this thing accelerates. At the same time, though, I'm pessimistic in the sense that there's not, we're not going to completely be able to offset those losses. There's still quite a gap. And so it points us to the point I was trying to make at the top, which is that we must seek resolution of these 232 tariffs between our two nations. That's simply a priority.
You mentioned dumping in your notes as well. What is the current volume of steel products from China entering Canada, and how does this affect local producers here?
Yeah, well, actually, the Canadian government has taken strong action on China tariffs. And despite, the recent developments between Canada and China, all of those Chinese tariffs have stayed firmly intact. And they've also expanded. So now it's not just steel coming from China, but directly, but also indirectly that is being tariffed. So we have multiple layers of protection against steel dumping from China. That's not to say they're not still here. Our shipment volumes have dropped by about 40% from China into Canada. We'd like to see that drop much further. And of course, we're still taking many trade cases against China. But what I can say is that the trends are heading in the right direction with respect to getting non-market economy, unfairly traded steel out of our market.
Okay, is Canada's steel industry currently equipped, do you think, to compete with China in the international market, like for Europe, for example?
Yeah, well, because of this phenomenon I was describing of overcapacity, we have very limited options in terms of diversification outside of North America. That's been one of the unique features of the steel industry, is that we can't really just pivot to somewhere else. So we're really in a circumstance where we either have to, we have to develop our domestic market. That's where those border measures come into place. And then ultimately we have to see a return to, market access to the United States to kind of keep us level and whole.
Just lastly, very quickly, I want to bring Mexico into this too. Like, how can Canada strengthen steel trade collaboration with Mexico?
Yeah, that's one of the benefits of the CUSMA arrangement. Actually, the steel features of CUSMA have been very good to the North American industry as a whole, and create opportunity for more steel trade between Mexico and Canada. So, when we've had, when we both had access to the U.S. market, that didn't take. There was some trade, but not as much trade. And now we're starting to see growth in our trade flows between Mexico and Canada. Okay. It's early days, but that's very encouraging.
Catherine Cobden, President and CEO of the Canadian Steel Producers Association. Thanks so much for joining us. Appreciate your time.
Thanks very much for having me.
And stay with us. We'll be back in just a moment. Gold swung between gains and losses as investors weighed the Federal Reserve's interest rate path after U.S. data this week showed a war-driven surge in inflation. Bloomberg's James Atwood joins Vonnie Quinn on Bloomberg Markets. Take a listen.
Well, I think it's a case of gold being caught in a tug of war between inflation and interest rates, like a lot of securities at the moment. But gold traditionally is a hedge against inflation. Then again, gold doesn't carry interest, so when interest rates rise, relatively less attractive.
So I was speaking to Matt McLennan of First Eagle Value just the other day, and they have a 15% allocation to gold and trimmed it a little bit when we got to see the highs. But his point was that actually gold has really only returned to slightly below its 50-year average relative to equities. So this massive run-up that everyone said is overdone perhaps shouldn't be seen that way. What are analysts saying, James?
Well, there's been a few reports coming out about, gold being attractive again. Again, it depends on your view on inflation. It depends on your view on interest rates, and of course, what's going to happen in the Middle East. So yeah, again, it's caught between different dynamics or different tensions. So as inflation ripples out into the broader economy, what that means for gold, how central banks react, and of course gold is also typically has an inverted correlation to the dollar, or becomes more attractive as the dollar weakens and vice versa. So there's another factor in the mix.
What are we seeing from institutional demand, particularly China and India?
Well, from what I'm hearing, it's strong, but again, it's there's no clear direction right now, so that makes it challenging.
Canada is one step closer to getting a new pipeline that will transport Alberta crude to the West Coast. CTV News has confirmed a major piece of the puzzle has been addressed, but there are still many steps to go. CTV's Ottawa Bureau Chief Graham Richardson has more on that.
After years of opposition and protests, pipeline politics are changing. What seemed entirely unlikely just 18 months ago is now one major step closer.
Are you willing to allow a new pipeline?
The Prime Minister not confirming it, but sources telling CTV News his government and Alberta are set to announce a deal on a new pipeline to the West Coast.
I think it's a great thing for the industry, and it's a great thing for Canada.
This is one part of a complex process, and it was telegraphed last week by Alberta Premier Daniel Smith in Ottawa.
Sometimes it happens that you get the two principals in the room and you kind of sort through what some of the disagreements are. And I felt like we sorted through a lot today, had a meeting of the minds, and I'm hoping that we'll be able to announce an agreement very soon.
A key sticking point was the industrial carbon price rising higher each year. Sources say the Carney Liberals have agreed to slow the growth in the price significantly. Under the plan introduced in 2016, the carbon price was supposed to hit $170 per ton by 2030. Now that will be reduced and only hit $130 a ton by 2040.
Having investment in our own energy sovereignty. And I think in these circumstances, we need to adapt and we need to invest.
Some environmental groups would not openly criticize the shift, but they are clearly disappointed.
We've been suggesting that getting to $130 a ton for the Alberta industrial carbon price by 2030 was a reasonable and effective deadline. Instead, it looks like that's going to happen by 2040, fully a decade later. So that is disappointing.
Of course, hanging over all of this is years of acrimony between Alberta and Ottawa. Will this change all of that? Probably not, but it will be seen as one of the first positive steps in many years. Graham Richardson, CTV News, Ottawa.
Okay, that's it for us. Thanks for watching Commodities Today. You can always email your story ideas to commodities@bnnbloomberg.ca. Stay with us, though. The Close with Morella Fernandez is next.